everybody. It's Maynard, Mike, Matt, and Colin with, I know I always say it, but today is a must watch because today is almost like a prescription for the energy industry. We're really, really excited. We've got Tisha Schuller here with us today. Tisha is so accomplished, I will confess I'm going to read her bio, but I want you to hear everything that Tisha's done. She founded Adamantine Energy to future-proof energy businesses against rising social risk. She consults private clients from Fortune 500 energy companies to nonprofit environmental organizations in energy policy, business strategy, politics, and community engagement. She also serves as a strategic advisor for Stanford's Natural Gas Initiative. Previously, she was the president and CEO of the Colorado Oil and Gas Association and a principal and vice president with Tetra Tech. She has a BS from Stanford University. She serves on many academic and nonprofit boards. She's a member of the National Petroleum Council, an advisory board to the Secretary of Energy under both the Obama and Trump administrations. Her first book, Accidentally Adamant, was published in 2018. She authors a weekly series entitled Both of These Things Are True and hosts the Energy Thinks podcast. And this is her book, The Game Changers Playbook. Mine's all like this, Tisha, because we have a rule whenever we get to have an author on the show, we all read the book. So our little book club, we've read this. And because it's so uplifting with a good message, I put on a bright color today just to get in the Tisha mode of thinking, which is very optimistic and a prescription for success. So welcome, Tisha. Sorry for the really long introduction.
I'm so excited to be here. Thanks for having me. And thanks for wearing a bright color. It's that or rose-colored glasses. So I'll take it.
Hold on. Let me get the rose-colored glasses. I'll be right back. Okay. Fantastic. Thanks, Tisha. All right. Well, let's do a little roundup before we visit with Tisha. The market has been crazy as always. Mike Bradley, what do you got?
Yeah, Maynard, it's early in the week, and as you all know, crude oil went crazy last week. The equities went crazy on the OPEC, agreeing to roll over quotas until April. The week started, we've pulled back a little bit on crude oil, a couple percent. The equities are pulling back, but this is a naturally healthy thing to happen. We've gone so far, so fast. I think long onlys have now started to be a little bit itchy on the trigger because they want to see the group pull back, see where it stabilizes, and I think the money will be there to buy the group because I still think the inflationary trade is there. I still think people feel like return of capital of the group is there, and so I think there's some pent up demand. Today what we've also seen is energy has done well when the rest of the market has done poorly. You see the Nasdaq up 4.5% today. Names like Tesla up 18-19%. The ICLN, which is the Clean Energy Index, is up about 8 or 9%, and that's really underperformed traditional energy this year. So there's a bit of money flow coming back to the stuff that worked. The sort of momentum trade is winning versus the value trade today, and so we'll see how the next couple of days plays out. One of the last things that we've seen in our group specifically is we've talked about that there's probably a chance of secondary deals occurring in the energy sector. And we saw, yesterday 2 deals get announced. One got priced last night, and one is looking to get priced tonight. They're in the hole, which doesn't surprise us whatsoever. But I think the point is that the names have run a long way. Private equity sponsors and others that have seen them run a long way are taking the opportunity to tap the market. I would say that's not a sign that this is the end at all. This is a sign that stocks have run a lot. People are taking some money off the table. And that's healthy. So that's kind of where we are right now. Like I said, the groups pulled back after a long run. Not time to panic. It's time to basically start sharpening your pencils and say, what do I want to own more of? Because we've talked about this before. We think this is not going to be a 3 or 4 or 5 month run. We think this could be a multi-year run for energy, and that's where we're staying.
What's the price of oil embedded in some of these upstream stocks? I don't know, Mike, or maybe Matt, that's a question for you.
That's a good point. I'll answer it. I mean, Matt can elaborate, but it's mostly probably strip prices right now, a little bit below strip prices, and so that's one of the issues, right? The group has run a long way, and so it was back when the strip was $40, $43, $44, and people thought normalized is more 55, 60, easy play. Now it's normalized is more in line with where the strip is, and now you really have to start to make the leap of faith of, okay, who do I want to buy? Who's going to return the most capital back to shareholders? That's a whole discussion point altogether, and that's a healthy one.
And Mike hit it right on the head, and that was actually something I was looking at as I came into the meeting today. We've been getting client questions on what is the group discounting. And there's a couple ways to look at this, Maynard, and it was actually something I wanted to touch on because we have seen a change in the valuation metrics for the sector over the last 3 to 4 years. So if you take a step back in 2017 and early 2018, that was really the last time we saw clients heavily lean into the net asset value framework for E&Ps. And really, I think the shift you saw was a change towards a focus on what's the actual underlying cash flow stream of the business. And if these have to become self-sustaining business models, what type of metric should I be looking at? Just looking at EV to EBITDA metrics, I think what it did is it was a fairly shorthand discussion around getting to the bottom line, which is what kind of free cash flow generation should we expect from the space over the short, medium, and long term, and ultimately how much cash can come back to shareholders from that free cash flow generation. And in 2020, we really saw the adoption of two different metrics, which one is very standardized across, I think, multiple sectors, obviously free cash flow to equity. And the other that is being discussed more frequently to try to normalize balance sheets is free cash flow to enterprise value or free cash flow to EV. And so at the end of the day, we see a hodgepodge of valuation framework that is kind of overlaid on the E&P sector. NAV still has some relevance because clients care about what the long-term inventory looks like and what the asset quality looks like. But I'd say that's probably at the bottom of the list. EV to EBITDA metrics are still relevant because that really gives clients an idea of how companies are trading relative to each other. But I think the absolute framework that we're shifting towards is a free cash flow to equity or free cash flow to EV metric, which really highlights how much free cash can these companies pay back to shareholders. And I think that's topical for two reasons. One, most clients we talk to are of the view that the industry as a whole in the US, and we would agree with this based on our analysis, most companies have 5 to 7 years of tier one inventory left to develop. Some that are in better positions have 10 plus years, but the vast majority of the industry is going to chew through the best acreage they've got over the next 5 to 7 years. So you have a degradation of capital efficiency over the medium term, and that in conjunction with concerns over medium term demand risk. And we've talked about gasoline and our work on gasoline peak demand potentially emerging in 2026 or 2027. So part of the crude stack starts to decelerate, creates some demand risk longer term. I think that just creates some concern around terminal value. And as that is the case for this sector, clients are willing to look at what they can actually receive from companies in free cash flow generation over the next 7 to 8 years, and they're using that as a discount rate. And so as we look at the space right now, the good thing is stocks are not expensive relative to other indices. And we wrote a blurb on this last week, just highlighting that the energy sector overall trades at one of the highest free cash flow yields to equity, one of the highest free cash flow yields to enterprise value of any of the sectors in the S&P today. And quite frankly, the upstream space looks quite attractive. You look at metrics on 2021, we're trading in the mid-teens on a free cash flow to equity basis and in the low double-digit range on a free cash flow to EV basis. So as long as companies actually execute on a return of capital strategy, cap that growth rate going forward, I still think it's a very healthy investment proposition. But we definitely have seen a change in how clients are thinking about the valuation framework over the last 3 years, and that is becoming more topical as we move forward from here.
So one question, Matt, a lot of times, pick a place. If you were in Boston and someone starts talking about terminal value for oil and gas, they're, in my estimation, they're kind of referring to, hey, we're not going to need this stuff for so long. Like that, it's kind of a reference to something like that. The terminal value that you just referenced is you think in 5 to 7 years, a lot of these companies will be out of their best inventory, and therefore the terminal valuation at that point is not large. But am I right thinking about that? Because the terminal value gets thrown around a lot with different meanings, is my interpretation.
I think it's the intersection of two things. I think it's the intersection of, if we do see a peak demand scenario, let's say in the next 10 years, what's your marginal barrel priced at? And then the second intersection to that is, what is the marginal cost of production out of the US if we chew through a lot of our tier one inventory and we have a degradation of capital efficiency moving forward? And so what are those tier two barrels worth in a slowly declining demand world. And that, I think, is why clients are really willing to underwrite the next 7 years on demand and kind of really willing to underwrite the next 7 years of tier one inventory. And that nicely coalesces to kind of a 10-ish% discount rate when thinking about what sort of cash they can repay back in terms of that free cash flow generation.
I mean, isn't it also, given that the energy stocks have not made money for people over a number of years now, and it's been volatile, the world is just saying, hey, if you want me to come back, you got to pay me, at least initially, until I get comfortable again.
100%. And I think what clients have reflected to us, especially long-only clients, is the shift away from NAV has been extremely helpful, because under a NAV framework, accelerating the drill bit and using debt capital financing was the path forward, and that generated the most net asset value. And that put the industry into a really unhealthy position in 2014. And we've gone through a painful kind of restructuring process since then. So this focus on free cash flow generation actually works to the benefit, I think, of the industry, because it creates a healthier macro backdrop. And quite frankly, it's a very easy valuation framework to look at across multiple sectors and not have to have this kind of unique framework that we had kind of created for the energy industry specifically, or specifically for upstream, that really didn't correlate to really other investment opportunities in the broader market.
Well, just think of it this way. You can take your NAV models and you can start using them on lithium and cobalt. Maybe someone will listen to that. Okay, anyway, thanks a lot, Matt, and apologies to our friends in Boston. Viv, if you saw that, you know we didn't mean it. Colin, you're the last stop on our way to Tisha. I know you got some great stuff and maybe a little bit of warm-up for our friend Tisha.
Yeah, this week we have 10 observations on commodities as we approach the 1-year anniversary of the COVID-19 lockdown. And point number one, forecasts of a super cycle are correct, but they're early. Capacity remains slack. And so to demonstrate that point, we look at capacity utilization in US gas-intensive industry, see a lot of numbers in the low to mid 70s. Now, a 70 here isn't like in school where it's like an F. Somewhere around 80 to 82 would be a good number, a bull market number. And so in chemicals and fabricated metal products, we're not so far off. But primary metals gives us a warning here with that 69%. So we have room to move. And you can't be in a super cycle if you don't have demand pressing the limits of capacity. It's kind of the definition of a super cycle. So one way that we might quantify that is looking at the S&P GS Commodity Index Total Return Index. You can see that the current observation isn't even quite to where we were in the pre-COVID period 1 year ago. And so the punchline is investors can look through these kinds of delays, this kind of slack. Operators can't. And so what's happening today in the oil market with crude down $1 and what we're seeing in some of the other commodity markets, it's just a warning that the super cycle thesis can be correct, but it can take time. Two things can be true at the same time, as our guest will remind us. And the upshot of that is the boom hasn't even started yet. And so there is a commodity bull market sitting out there. And we've shown this chart before. 1 year ago, we had a 5% contango between month 1 and month 24 at about 37% volatility, leading us into this insane period of volatility here in this red box. Where are we today? As of the end of last week, 16.8% backwardation at 27% volatility. That's pretty much where we were the first week of January 2020. So we are back. We are back to the starting point. And to Mike's point, now we can sort of digest what that means and move on from here. All right, moving through the remaining points. Point number two, a 40-year plus fixed income cycle has begun. We're in a new cycle. So that 1982 to 2020 period that gave us mostly low volatility, as you can see here in the 1980s, is over. And the kind of message we got from the bond market a week plus ago is something we have to really pay attention to. Bond markets, unlike the central bankers, do think that reflation has become inflation. They do think that we're in a period of time where just the average consumer is going to see higher prices. But again, what we've seen in recent weeks is it doesn't necessarily mean that it happens in a smooth fashion. You might find fits and starts. And so point three is California in 2020 and Texas in 2021 are teaching moments on why this concept of a game-changing playbook is right. And it's real and it's necessary, but it's not costless. We have to be thoughtful in how we bring all stakeholders together for thoughtful planning. Now, we also see a universal belief in pent-up demand that's likely to come as we reach some threshold for vaccinations. I think we all know that that's true, but there's one potential surprise here, and that is that this pent-up demand may just very well reinforce the kind of K-shaped recovery that we've seen so far. It may very well be true that a month from now, a lot of people hop on airplanes and go to Florida, and or even in a couple of weeks and have a nice spring break. That is not going to be the case for tens of millions of people in our society here in the United States and more broadly globally. A lot of pain, a lot of trauma, a lot of lost businesses, a lot of lost jobs. So let's not forget about that side of the equation. Point number 5, we have seen a lot of commodity price spikes recently, but often they've reflected spot shortages due to idiosyncratic events. So here in this chart, we show the Shanghai Containerized Export Freight Index. It's a measure of spot container freight indices. And think of this as California suddenly locks down in December. There are a bunch of container ships off the port of Los Angeles and port of Long Beach, and they just sit there. They're stalled. The next customer was waiting for that container ship to show up. Maybe it was for grains, maybe it was for something else, and it's not there, so they have to, in a frenzy, try to find alternative modes of transportation. And this feeds on itself, and it becomes, particularly in an environment of very loose money, something where we can see people willing to spend a very large amount of money in a very short period of time to fix their instantaneous problem. That is not at all the same concept as a super cycle or a demand-led rally. That is a supply shock. Point 6, gas is probably the most important commodity of the 21st century. We've said this many times, both as a fuel and a feedstock, but this embrace of the concept of blue hydrogen is a crucial signal. It shows that we're seeing some of the more extreme portions of the marketplace have to acknowledge that we probably will be using natural gas for decades to come. We may call it something different. We may begin to rebrand some of these commodities. But what I like about this chart is here is 2020 on this vertical, 2030 on that vertical. And supposedly we're already at the process of capturing all the CO2 for underground storage. We all know that we are not there yet. So this may be a good schematic for some forward interval of time, but it does reveal the truth, which is that we're going to need hydrogen at a minimum and possibly hydrocarbons for quite some time to come. Point 7, we've seen incredible responsiveness in U.S. gas and oil production. U.S. gas supply cuts have mainly come through the smaller basins. We've seen more resilience in the larger ones. So here we show Anadarko has basically lost 25% of its output. Appalachia is actually up a couple of percentage points. Point 8, absent the weather, global gas demand actually remains pretty weak. And this goes back to point 1. If it were not for the incredible cold that we saw in Japan, Northern Europe, the mid-continent of the United States, we still have pockets of pretty significant industrial and power weakness for natural gas. Now, the good news is already in the data for January, we can see the end use demand for products that are gas intensive beginning to pick up. And so that's a good sign for the upstream. Usually it would take about 4 to 6 months to see that pass through into the upstream. This time around, because it is a self-inflicted lockdown, it may very well be only 2 or 3 months, meaning it may be starting right now. And then the final 2 points, China, of course, crucial for commodities, especially energy and metal commodities. We're seeing a pretty meaningful slump in CapEx for the Belt and Road Initiative, a drop of somewhere in the range of 45% for energy in calendar 2020. Crude storage has breached 1 billion barrels, according to satellite readings, and we're seeing soft imports in response to price. Let's keep in mind that we had month after month in 2020 of China taking more than 11 million barrels per day of crude with a handle somewhere in the 40s. So there's no need to chase the rallies that we've seen in Dubai, Brent, and TI. And we're also seeing China very much focused at present on launching its own carbon futures market in June. And then finally, point 10, and this leads into what our guest is going to help us understand. Energy is an indispensable industry. It may change flavors. It may have to confront new realities, but it really is a source rock and a feedstock for all other industries. It really is, a core value. And right now it's cheapest price. So as we look forward, we really should be looking for energy to be a provider of returns, a leader on ESG, to take all of this innovation and technology that has come repeatedly from this industry and help bring us to a better spot.
Fantastic. That was a great lead in. Thank you, Colin. We got to circle back when the Chinese open the carbon trading market in June. We'll have to be sure and talk about that. So Tisha, welcome again. We're so happy to have you. Your book, we all came into the office because I think we did do our homework in the last couple of days before today's test. But, some college habits never die. But your book is very uplifting. And I feel like if I got to get out of the way so you can start talking, but you're an oil and gas person. You worked in oil and gas. You were head of KOGA. I mean, you know oil and gas. And you speak to oil and gas as a veteran, but as someone who's been works with environmental organizations. And I feel like the title is like, take back your life, like go on offense, be a disruptor, stop fighting stuff you can't change, and get in the game. But what would you tell us? I know you wrote it during COVID. Tell our audience just an intro to what got you so excited to write this book. I know you've written others, but we'd love to hear it.
Thanks, Maynard. It's so great to be here. I think the key feeling I wanted to address with the Game Changers Playbook was this wait and see that I felt like our clients and the audience for my weekly email, everyone was sort of poised on their toes for what's going to come next. And it felt like everything that kept coming at us was bad, whether it was a new climate-related expectation from an investor or another shock around price or opposition. And what I kept thinking about was that advice we've all gotten from some mentor along the way, which is that the best acceleration of a strategy can happen during a crisis. And so I was really digging deep to try to figure out what's the moment that we have here. And it really came out of this idea of rebuilding our society together and having the oil and gas industry lead that. And that's where I started, which is funny because that's actually the end of the book. But I started at the end and worked backwards because when I ran the Colorado Oil and Gas Association, we had devastating fires, devastating floods in Colorado. I saw the oil and gas industry rally again and again, not just with money, which they did with millions of dollars, but shovels and trucks and hauling diapers to people who couldn't get them. And just this amazing sense of civic engagement and leadership. And I thought, as our nation and as the world is recovering from this pandemic, how do we tap into that spirit we know so well of civic leadership? And then I worked backwards from there to figure out, okay, what are the disruptors? What values do we draw upon? And how do we reposition us to be the game changers, as you said, to stop being receptive to disruption and really go on offense and be the disruptor? Well,
your book, it is a great read. And it reads very quickly because it's so good. I mean, it flows really well, and it speaks to all of us who've been around oil and gas. And I think there's so much we could talk about here, but one of the things that you do is you lay out some of the arguments that we all have, that many people make, and they're sort of sometimes grounded in economics and sometimes grounded in engineering, and there's various observations, and you sort of point out we need to stop doing that because the world's not listening. The world is tuning us out. And you also point out, even when we say we need to educate people, like even that is sort of flawed in terms of how it's an approach. Would you mind just elaborating on that a little bit?
I'm so glad you brought that up, Maynard, because I learned this the hard way. I'm a scientist. Of course, our industry is dominated by scientists and engineers, and we love nothing better than to do the math and explain it to everyone else. And you know how well that goes over with your spouse or your high school age child. Nobody particularly enjoys being explained to, or let me tell you how this really works. And unfortunately, when I started at KOGA, with my scientific background and a tiny bit more background, I'm a hippie girl from Boulder. But because I'm a geologist and I love the oil and gas industry, I thought I can do this. I can explain to all these scared moms why fracking isn't the thing they need to be worried about. So we hired a research assistant. We made 30 fact sheets, and I hit the road. Every town hall, every Rotary club that would have me. And I pretty much just over time and time again got run out of town. So why is that? And I'm going to just boil it down to a couple really straightforward things. And then, of course, we could talk about this for 10 hours, but we won't. So there's essentially two mindsets in the world right now. And I would say ours, which is kind of the way things are. We do have the facts and the science and the physics on our side. Like we understand. I love the way Colin talked about the source rock. Energy is the source rock. I think of it as the lifeblood of prosperity and economies. And we know that, and we know that the world is going from 7 to 10 billion people that need energy. We get that. And we can do the math and we can say why actually oil and gas are going to be really important for a long time. We know that part. Here's the part we need to be aware of. There's another mindset, a growing mindset. I might even argue that it is now the dominant mindset in developed economies. And that is that climate change presents a moral obligation for us to address. We need to do that by getting off fossil fuels. And in fact, and Colin referenced this, in fact, we'd already be there, if it weren't for these companies and the politicians they control. And there's sort of this idea that we can and should already be fossil free. Now, here's the thing. I don't say that to critique that mindset. Our job now is to be skillful, to understand that mindset, to engage with that mindset differently, and to understand that this really dominant perspective comes from people's identity of who they are and also their deepest seated fears about the present and the future. So now as an oil and gas industry, for us to engage, we have to engage differently, saying, okay, what's the way to create a common vision, a shared value, a different perspective of the future? Because all of our explaining about the way things are isn't going to work. And there's lots of scientific data that shows us why it won't work, but that gives us an opportunity to try to do this differently.
I mean, one great point you're making that we've been struck by is the issues around energy, the environment, the economy, the global economy, the Paris Climate Accords, the complexity in that body of science and law, and I mean, it's massive. And so there's no way for the average person, unless you're intimately involved with it, there's no way for the average person to really have anything more than a feeling about which way we should go. And so I think sometimes people feel like they're criticizing, well, you just have a feeling. Well, how could they have anything more unless it was their profession? So I just feel like I'm reiterating your point, but it is so complicated. People aren't going to take 2 weeks and do nothing and decide to really think about energy policy.
I would add to that. We like to say in the industry, let's have a rational conversation. Let's bring the emotion down. One, never going to happen. Two, we bring all our own emotion to this. We feel defensive. We've transformed the world for good. Why aren't you saying thank you? We bring our own emotion to this as well. So actually, we can be more successful if we just get okay, we are in emotional territory. We are in political identity. Now, how are we going to win at this game? How are we going to engage differently in a way that's going to transform the conversation and make room for us to continue to create prosperity?
So one thing your book does, which is great, you talk about disruptive factors that are leading to this, and here you've just gone through a great explanation of why people are, what the dominant prevailing mood is, and in the book you show there is generational change going on. So one of the first things you talk about is millennials and how they see all this and how they're looking for purpose, some of those things we all know about millennials. But maybe, Colin, this would be a great time to show the chart that Tisha's got in her book that really gets to the point. And Tisha, I might ask you to explain it.
Sure. So what your audience can really take away is that millennials are poised to dominate population really through 2050. And what the chart shows is other generations coming up, Gen Z, the generation that follows Gen Z, AA. But from our perspective, we've been talking about millennials as an industry for 15 years, but now millennials are turning 40. So they're in the prime of their civic, political, economic relevance. And so it matters how millennials feel about oil and gas and climate to how we engage with the public. And so just understanding, first of all, that not only are millennials dominating, but now every community that we engage with as stakeholders, the people that do our regulating, the investors who are making decisions about how to allocate their resources and what kind of pressure to put on our companies, these are often millennials. So you can take the chart down if you want, but here's what you need to know about millennials. Overwhelmingly, by 20 points, they lean left. That won't surprise anyone, right? Younger generations always lean left. But here's the thing. Of course, there's conservative millennials. We all know 3 of them, right? There's conservative millennials. But even where conservative, they prioritize addressing climate, and less than half support fracking. Just to give an example, less than half of conservative millennials support fracking. So millennials overwhelmingly want to see climate change addressed and are suspicious of our industry. So now this is the stakeholders we're overwhelmingly engaging with. And so knowing that can allow us to rethink how we have these conversations. This isn't educating our kids at the kitchen table. This is saying, okay, what's the world look like to you? Now let's find some shared way to talk and think about the energy future together.
And one thing you said in the book that was interesting is millennials, I'll get your words wrong, but basically a distrust of organizations, governments, businesses, etc. And so the way they sort them is they look at the kind of the social profile of that organization. So if it's talking about things that are important to society at large, if it's getting involved in ways that corporations haven't historically, then the millennials say, that's a good company, or that's a company I like, or that's a company I can trust. And that seems to be a big part of what's missing in why oil and gas companies haven't resonated we would want them to.
There's so much in that, what you just said, Maynard, and there's so much opportunity in that, because as you alluded to earlier, most of our feelings outside of energy, for me, for example, around healthcare, are very shallow, and my beliefs are very lightly held. So if someone presents an opportunity for me to trust them and look at things differently, I'm going to take it. And that opportunity exists in energy, particularly because no one really wants to give up anything. So as Colin alluded to with there's a cost and we have to be thoughtful about this. Most people don't really want to give anything up for this energy transition. And so there's an opportunity to say, okay, let's imagine this together and let's create a space to do it mindfully over time, thoughtfully. And the visual of our hydrogen is so perfect, because what we really want to do is make that middle space for blue hydrogen in oil and gas in all its forms. And how do you do that? You have to have a different kind of conversation about the energy future.
I'm going to get out of the way because I'm having too much fun, and Colin and Mike want in here. But and Colin alluded to it in his slides, you have, these 2 things are simultaneously true and conflicting. And you write, it is true that we in the oil and gas industry can no longer ignore a public who increasingly does not like us, trust us, or value the critical work we do. That's your first point. But your second point is, it is simultaneously true that we, the oil and gas industry, can invent, accelerate, create, and execute on the decarbonized energy future faster, better, and cheaper than any existing agency, organization, or system. So we're in last place on the popularity meter, but there's an opportunity for us to soar to number 1 because we can save the day. It's a really fun, I think that's almost like the central foundation of your book.
Thank you. I love that you read that. And it is what wakes me up every morning, is that for anyone that's serious about addressing climate, oil and gas industry is your greatest ally. The challenge is the industry has to say, here we are, ready to lead, ready to be your greatest ally. And and that, I think the burden is on us to transform the paradigm that we're having this conversation in.
I'll tell a story. So that figure that we just had up before really shocked me. With the boomers already outpaced by the millennials, I didn't know that, and I really was kind of stunned by it. And then I'm Gen X, as I believe you are as well, and Maynard, you're one of us as well, and Bradley too. And if you go back to that chart, boy, did we fall off fast in the next few decades, which is not welcome news. But and then there's Gen Z, and my kids are Gen Z. And during the blackout in Texas last month, my son and I, he's 11, we're talking about electric vehicles, and I said, hey, do you want to get an electric vehicle for the next car? And he said to me, what if the power goes out? And I thought, this is literally coming from, he has his little iPhone, and he just probably saw something about the power outages. And if it had happened a month before, a month later, I would have had a completely different answer. And so as I read your book, I really was thinking a lot about these two things: the surprise of how large the millennials are, and then also how sensitive everybody's opinion is to what you just heard 5 minutes ago. And that it does seem to be the case, as you point out in the book, that the engineer and scientist wants to make the case and then end of story, and then is like befuddled that the people don't remember it or aren't paying attention. I guess the question in there is, in the book, you talk a lot about decarbonization. Is that because you think that's like the first task that has to be won? Where does, as a Boulder person, biodiversity, animals, ecosystems, all the other aspects of environmentalism fit into the picture?
Colin, such a great question. And we should enjoy this 1 minute of celebrating Gen X, because it's the only time on planet Earth it's ever happened or will ever happen again. We're the forgotten generation. So that was nice. I enjoyed that. So here's the way, the most important game changer for being the disruptor ourselves, and that is to share aspirations with the public. And that's why decarbonization features in so prominently. I have experienced firsthand going into a room of hostile regulators, for example, who really feel that their job on some level is to squeeze the industry out of existence. Although they have more pragmatic tasks to do today. That's what the general feeling is. I'm in Colorado, so people will recognize the thread. If a company comes in and says, we too prioritize climate, we too value a decarbonizing energy future, and what we want to do is collaborate with you to be your greatest ally. In order to do that, we have to look at this 30-year time frame and work backwards, and then think about what we need to get done today. And so the focus on a decarbonizing energy future for companies to create a decarbonizing toolkit to talk about their role in the energy future, this is all about a paradigm shift. Now, we are on the same side of the table looking forward, and we can have a robust, healthy debate about how to get there. The really interesting thing about millennials coming into their prime is now they are tasked with leadership and governance. And as we've all seen, as people move into leadership and governance, the trade-offs become real. You need revenue. You need to actually meet the needs of your society. You need to create prosperity. And all of these things make room for that pragmatic conversation that we scientists and engineers have been wanting to have from the beginning. But first, we have to make space for it. So sharing aspirations, talking about climate, talking about a decarbonizing energy future makes space for a pragmatic conversation about, okay, what do we need to do in 30 years, 20 years today? Turns out we do need those pipelines. Now we can talk about it.
Can I ask you, I think it always, we have a tendency to look at our world and there's so much red and blue, and it's like, everything is red thinks this and blue thinks that. We were on one of these discussions one day, and we couldn't help but notice, oil and gas is happening just physically in red areas. So like my kids had little league coaches who worked for oil and gas companies. So of course they thought, oh, that's where Coach Docs works. I mean, that's a great guy. That must be a great industry. And if you grow up in California, you don't have that, just to pick a place. And so is it just geography that is leading? What is driving this, the politicization of oil and gas in particular?
Yeah, so I really got to live this in Colorado. 10 years, we went from red to purple to blue to reliably blue. And we have areas, red areas of the state that are pro oil and gas, and blue areas of the state that people will set up the next, protest of the ages in order to prevent gas or oil from being produced here. So I've really lived this full time. And here's how I think we landed here. At some point, climate was also nonpartisan 10 years ago. And even when I started at Koga 6 years ago, natural gas was a climate friendly solution that we could talk about. And so when climate became identified with political identity, everything got echo chamber enhanced. And I think that actually, rather than dissect that, which we could go into, and there's a lot of interesting stuff there, but the more interesting opportunity is how do we break out of that? And again, I think there's a real opportunity for the oil and gas industry to say, I'm going to set aside my political identity. I'm not going to think about this energy climate decarbonization thing as they won or those people. I'm instead going to think about it as a hurricane off the coast. When there's a hurricane off the coast or some percentage that's coming from my facilities, and I'm going to deal with it as a risk. And so a lot of what I try to do when I look at disruptors and think about disruptors is think about them more as risk with a percentage of landing on our operations and our opportunities to say, okay, there's a risk that all my stakeholders are going to prioritize climate. How do I engage differently? And so it's a leap of faith for industry leaders to say, I'm going to set aside the politics of this. I'm going to engage in this as a risk mitigation measure and then as a leadership opportunity. But that's really what we have to do, because that politicization is not going to get better.
Yeah. It hardens opinions. You think. One question for you. So, Tisha, I think in the book you just referenced it. Millennials today are like 24 to 39 or some number like that. That's how old they are, right? So we probably don't have many energy, classic energy CEOs in those ages. But I would guess tech companies, a lot of other companies, they do have millennial executives. They're probably, and you referenced this in the book, they communicate with millennials like millennials. They are millennials. So they may have a better, it may be the case right now, millennials are naturally drawn to industries where millennials are on top and naturally pulling away from industries where millennials are not. Is that another way to think about all this?
That's actually really interesting. Although about 45% of people that work in the oil and gas industry are millennials. So we have this tremendous secret weapon, because if we start moving millennials up into our most important strategy meetings, our most important external facing communication engagement, now we can have millennials communicating with millennials, as you said. So I am less worried about millennials leaving for tech, for example, and more interested that we're maximizing the efficacy of our millennials being engaged in a really meaningful way. And because we're more traditional, people, are moving up the ranks kind of slowly. One of my arguments I make in the book is that we should have millennials at every strategy table. And they do shake things up. And it is challenging to the way that we wish the world would be, especially us Gen X have been waiting forever for our chance. But we're just going to have to listen to the millennials, because they have some really great different ways of thinking about how we should engage in the world. And a lot of it is around innovation.
Well, it's such a huge group. We're, of course, guilty of generalizing about them. They have, so many different feelings and shapes and sizes. One of the things neat about the book is you do give so do this, so do the following. It's not just an analysis of the problem. It's here's do the following. And one of them on millennials, you say, start a shadow board, get them involved in innovation, kind of turn them loose ahead of their time, so to speak. Anything you'd add? Because that seemed like a neat thing to do if you want to attract talented young people to your organization.
One of our clients just brought millennial leaders into all of his different leadership functions. So they're whatever teams they have, they meet different kind of leadership team committee meetings, he brought in a millennial to those. And he said, even though he had a very diverse leadership team, it was the millennial perspective that surprised them all as how different it was. So that's one opportunity. And then creating a board committee that gives specific tasks to a millennial shadow board is a great way to get their engagement and actually bring them into that accountability leadership piece as well, because that's critical for their growth too. They have to see the trade-offs of governance and leadership.
Yeah, Tisha, when I read your book, I was interested, one of your key points was millennials have an inherent distrust of corporations. And I would imagine that distrust for oil majors is at the top of the list. And so if that's the case, can oil majors actually be the ones that basically provide the solutions, or is this going to be this inherent tension all the time? And the reason I ask that too is that, within that, you've also got to look at what is the market perception of what they're doing. And right now, the market perception of what maybe Exxon and Chevron are doing is probably not as, far out as, BP and Royal Dutch. But when you look at equity prices, since a lot of these announcements, those European majors are really have underperformed. So you really have got to start to think about strategy in the context of what that means for earnings and stuff of that nature. What are your thoughts there? First of all, will millennials take solution from the oil majors, and B, how much of that has to be incorporated into the strategy?
I think a huge part of that is that the people most trusted to change someone's mind about the oil and gas industry is someone they know who works in the oil and gas industry. So polling showed that again and again when I was at the Colorado Oil and Gas Association. So a lot of this is having our own oil and gas millennials help us construct that engagement and external strategy. So that I do think it will completely fail if existing leadership frameworks keep doing what they're doing. To try to appeal to millennials, I think in the absence of doing something different, we will have the same result. But I do think that companies who look very specifically at their own authentic strategy, and here's where, Michael, I think your question is so astute, because trying to say, we're going to be a BP, we're going to become an energies company. One, it's not authentic. Two, it's not grounded in values, and no one's going to buy it. It's just going to come across as BS, greenwashing. And so a big part of how we recommend at my firm when we work with companies is that they engage in a very unique strategy to that company, grounded in their own culture, their own values, and their own pressures. So a lot of US companies have a 2 to 3 year runway before they even need to be talking externally in a really meaningful way about the energy of the future, for example. But they should be today thinking about where those pressures are coming from. If you're located in certain parts of Oklahoma or Texas, you're not going to have external community pressure right now to talk about climate. But you probably will have investor pressure within the next 1 to 3 years. So a lot of what we do is say, you really want to take a company's unique pressures and unique opportunities and develop an authentic strategy. And having millennials at that table is a way to give them buy-in into the future and have them talking to millennials outside of the company in a new way.
And I think the other question I have too is, we always talk about it from a corporate mindset, but what about from a political mindset? Congress. I don't look at Congress as a bunch of millennials. It's a bunch of old people trying to take a bunch of advice from millennials and craft stuff. How much turnover do we need there to really accelerate this?
Yeah, so the great secret of the Hill is that it's 21-year-old staffers deciding all of those meetings and half of the language that's going into those bills. And so it actually is really important that we have a strategy that resonates with millennials and pretty soon with Gen Z as well. And so this is where that idea comes back to sharing aspirations and then articulating not just a role in the energy future, but a civic leadership role. And this a place that industry goes so naturally in a disaster. In any flood, for example, the industry just rolls out the red carpet to take care of the community. This is the kind of leadership stance that you see other corporations taking for pandemic recovery. And I think we have the opportunity to step in and take that kind of leadership now as well. So there's the sharing aspirations around energy, but there's also engaging in a meaningful way around racial equity and justice, around economic recovery from the pandemic. These are all ways that we naturally engage in our communities, but we need to be thinking about articulating more broadly.
Yeah, and in the book, for the benefit of the audience, you call those the three disruptors: the millennials, the activism, and the diversity, equity, and inclusion piece all are important, all are here, all cannot be denied, and all must be embraced. And one thing that really struck me, if you don't mind me reading a paragraph of your own writing, back to you. Clearly, if you are embracing disruption, you cannot get too tied to a particular vision of the future. So there's always room to find shared aspirations, which can lead to a shared vision. And I just really like that as an encapsulation of something that just sounds like really good advice, that, embrace the disruption. We try to do it at TPH with our new energy team and, our respect for all flavors. And we also try to be balanced too in finding, the path forward that seems to make sense and brings everybody along, as opposed to picking a specific future. So no question, but I just wanted to compliment you on that.
Thank you. I love it that you mentioned that, because a great thing for your audience is our industry has a 150-year history of entrepreneurial leadership. We have pivoted again and again, whether it was to gas lighting, or the internal combustion engine. So why wouldn't we lead into the next chapter of increasing prosperity and raising quality of life around the world? Of course, we're going to lead into that. And it's such a point of pride for me. And it's such a point of pride for our employees and our leaders. So it's funny that we find ourselves on our heels trying to explain things, when really we just need to get on our toes and say, yep, we're here, we're leading, we got it. And I would imagine, and maybe you guys will do this and show me a chart, but I would imagine that the vast majority of new energy R&D investment is happening in oil and gas companies and in oil and gas collaborations. And I think that the energy transition happens better, faster, cheaper, safer, more reliably with us engaged.
I would say, Tisha, I would agree with that. And the one thing I'd say is the oil and gas industry over the last 2, 3, 4 years, it's really been under serious pressure because commodities have been under pressure. So when you're fighting from the point of defense for the last 3 or 4 years, it's really tough to go on offense. And I think that people don't realize is prices stabilize at these levels. These guys are able to, earn a decent return. They're going to be able to plow money back into these areas. They're going to be the growth future. And I think that's way underestimated this time. And it's easy to really just pound away in these companies because they seem like they don't care, but they do care. But they've been under so much pressure for so long, and now they're kind of seeing light at the end of the tunnel. I think you're going to see some really good things.
I think that's great. It's such a great time as we come out of the pandemic for us to position with a vision of the future. And there is a reset. Everyone's going through a reset. And there's an opportunity for us to join these tables and have new kinds of conversations about creating the future.
Well, I hate to say it, but we're kind of at the end of our hour. The book is The Game Changers Playbook. It is unlike other books about the current energy discussion, which are, we've had some great ones, and they're analytical and they're incredibly thoughtful. Yours, as it says, is a playbook, and it's full of optimism about let's get out there, let's engage, we can do this, look at our history. And you also make great points about the early days of oil and gas. If you think about explorationists and, the culture we came from, we're just as out there as any dreamer industry there is. So I thought that was a really fun point. So I think you were saying bring the dreams back and don't forget we've always had them.
That's absolutely right. I couldn't be more optimistic about our future.
Well, Tisha, you've done the world a great service, and we'll, in our blast, we'll tell people where to get the book and how to find you. And we're just so glad we met you. It's always fun to make a friend, and thank you for what you're doing for all of us.
Well, thank you guys. Couldn't do it without you. So thank you.
Well, you've given us some lessons for close of business. Maybe we're going to, try to take to heart some of your messaging. So thank you. And thanks everybody out there. Bye now.